God help you if you tried to short gold this year. The analog version of Bitcoin just posted its best Q1 return since 1975. We've seen Wall Street's price targets obliterated, raised, and obliterated all over again. So, today we ask for the umpteenth time. Is the top in? How is this thing still going? What's driving the price of gold?
And why?
My name is Nick, and stay tuned to find out all the answers. Gold has nominally broken the new all-time highs more than 25 times in 2025. It's a rally that seems to have no end, and it's all very exciting and maybe even a little unsettling, until you check out the price of gold in real terms, that is. The value of gold is typically measured in US dollars, but since the purchasing power of the US dollar erodes over time, you need to adjust for inflation to find the real price of gold. As it so happens, gold's previous all-time high in real terms was set in January of 1980, when it hit $850 an ounce. And this followed an extraordinary bull run in the 1970s that saw gold 10x in dollar terms amid runaway stagflation. And by the way, if you're still not sure what stagflation is, you can find out by watching our video right over here. Anyway, a decade of global macroeconomic shocks and wage price spirals in the 70s caused US inflation to reach as high as 13.3% in 1980, undermining confidence in the US dollar and thereby driving up demand for gold as a safe haven. Gold only topped when Paul Volcker was appointed as the chair of the Federal Reserve and set about crushing inflation by raising interest rates as high as 21%. Believe it or not, but gold's price in real terms only recently surpassed the 1980 all-time high of $850 an ounce, and that's $3,400 an ounce in 2025 dollars, which is quite crazy when you think about it. Gold breached this critical level on April 21st when it closed the day at $3,424. It didn't stop there though, as the very next day the price touched $3,500 an ounce. And this proved to be a major zone of resistance, sending gold tumbling back down to $3,200. But the dip got bought, and price has since bounced back up to close at $3,430 and counting. In case it wasn't clear enough, the velocity of gold's uptrend has been increasing since the first week of April, when Trump's Liberation Day market crash put a floor under gold at around $2,980. The chart continues to make higher lows, suggesting the market is still in a buy the dip mode. However, at the time of making this video, we can't ignore what looks like a perfect double top on the daily time frame, and on the weekly time frame, a huge zone of resistance above $3,330, where price has been rejected for 4 weeks in a row now. At first glance, it looks like gold is starting to get a bit toppy. And if you need further evidence of this, then consider that we recently saw Goldman Sachs and JP Morgan announcing that they were significantly upping their gold price targets for 2025. To $3,675 and up to $3,900 an ounce, respectively. Funnily enough, both announcements were released on April 22nd, just as gold rallied to $3,500 an ounce and was sold off aggressively. So it's clearly a top signal, right? Well, not necessarily. These price predictions were only the latest in a long series of price targets that gold has shredded like confetti recently. Back in January, both Goldman Sachs and UBS were calling for gold to top out at $3,100 by the end of 2025. They increased these targets to $3,200 just weeks later, but gold breezed past this level on April 11th. In early March, we found Bank of America analyst Michael Widmer's ambitious target of $3,500 to be more persuasive, and that was because despite price already having rallied hard for more than a year, the fundamental drivers of the rally had not subsided. In particular, rising geopolitical tensions and US policy uncertainty have only pushed up demand for safe haven assets, minus US government bonds, whose status as a safe haven asset is coming under increasing scrutiny. At the time of making this video, the $3,500 target is still intact. But for how long? The fundamental outlook is no less bullish now than it was 2 months ago. So to find out why that is, let's take a closer look at what's sustaining this rally. And by the way, If you're enjoying this video so far, then let us know by hitting that like button down below. And you may as well want to subscribe and hit the bell as well to make sure YouTube gives you a bell as well when we release another one. Back to the video. Now, if you watched our previous coverage of the gold rally, you'll know that central banks have been leading the charge. Central banks have been net buyers of gold for 16 consecutive years now, but they have been accumulating relentlessly since Russia invaded Ukraine in February of 2022. And as you'll remember, Russia was promptly banished from the global financial system and had its foreign currency reserves frozen by the US and European Union. And this was a wake-up call to central banks around the world who learned that they could one day have their assets confiscated for getting on the wrong side of the US and the EU. And this accelerated the slow trend of de-dollarisation, most notably by China, whose reliance on US dollar-denominated assets is looking increasingly risky amid the ongoing trade war and spiraling US national debt. China is not alone, though. Geopolitical turmoil and looming national debt crises that appear to have no solution have brought fiat currency risk into sharp relief for investors around the world. And this has created enormous demand for gold, especially from central banks, whose gold purchases have roughly quintupled since 2022. And that's because gold is perceived as a store of value, invulnerable to the risks associated with fiat currencies in general and the US dollar in particular. It's a cornerstone of economic sovereignty that existed long before the dollar and is guaranteed to outlive it. With no direct link to national economic authority, it's also a hedge against geopolitical uncertainty that exists outside of the conventional international banking system. Now, where have I heard that before? Can't seem to put my finger on it. Well, anyway, the great rotation by central banks into gold has continued well into 2025, albeit at a slower pace than last year. Collectively, central banks accumulated a net total of 244 tons of gold in the first quarter of 2025, down 21% from the 310 tons they bought in Q1 of 2024. The biggest buyer of 2024 and 2025 so far is the National Bank of Poland, whose gold reserves have more than doubled since 2022, and this year surpassed those of the European Central Bank. Poland's central bank bought 61 tons of gold in the first 4 months of 2025, bringing its total holdings to 509.3 tons of gold. Now, to put things into perspective, the National Bank of Poland's quota for gold purchases this year is 90 tons. We can only wonder why the bank has chewed through 2/3 of it while gold has been smashing new all-time highs every few days. Perhaps they expect the price of gold to continue going up only for the rest of the year, and perhaps it will. And this looks more like the exception rather than the rule, though, because China's central bank has been a major buyer of gold over the last few years, but its purchases have slowed recently as prices pressed further into the banana zone. The People's Bank of China scooped up 30 tons of gold in the last 6 months, but this includes just 15 tons bought in the first 4 months of 2025. And this has brought its reserves up to 2,294 tons, which sounds like a heck of a lot of gold. But according to Goldman Sachs, this is still well below a global gold average allocation of 20% by central banks. According to the World Gold Council, it was 6.5% at the end of Q1, suggesting that China has quite some catching up to do, assuming it's of course reporting all its gold holdings, which isn't always guaranteed. This, Goldman now says, is a demand driver that could push gold up to $4,500 an ounce in what they call a, quote, extreme tail scenario. The bank said in a revised price prediction in late March, quote, if the largest official buyer, China, were targeting an allocation of 20% and maintained an average pace of 40 tons per month in line with recent patterns, we estimate it would take approximately 3 years to reach a 20% gold share. I'm not sure what recent patterns Goldman Sachs is talking about here, because China bought 44 tons of gold last year and 30 tons in the last 6 months, with a slowing rate of purchases as the price runs deeper into the mid-$3,000 range. As far as we can tell, China has never habitually bought 40 tons of gold per month, but we'll take their point. China's central bank is going to provide a continuous, if not price-inelastic, source of buying pressure as it slowly rebalances away from its dollar-heavy balance sheet and approaches a gold allocation closer to that of the Atlanticist countries. The good news for gold bulls is that China is not the only country that is underweight gold and trying to do something about it. Data from the World Gold Council shows that as of Q2 2024, the average gold allocation of central banks in developed markets was about 28%, whereas it was just 13% in emerging markets. And this provides useful context for understanding the de-dollarisation trend. It's not so much about shedding the dollar entirely as it is about a normalization of dollar-heavy balance sheets, particularly in emerging markets. It might have seemed like a good idea to have most of your eggs in a dollar basket at one time, but that world is receding, much to gold's benefit. Put differently, central banks are just rotating their assets into gold like they were supposed to. Anyway, this can also explain the conspicuous absence of the wealthiest economies among the central bank buyers of gold of late. For example, behind Poland and China this year was Kazakhstan, which added a net 6 tons of gold in Q1. Next up was India with 3 tons, Turkey with 4 tons, Qatar with 3 tons, and Egypt with 1 ton of gold accumulated in Q1.
Oh, I didn't see you there. Well, now that I've got you, I may as well let you know about the Coin Bureau Deals page. It's over there where you'll get $100,000 sign-up bonuses on the best exchanges in crypto, as well as 60% trading fee discounts on said exchanges. And you can also get discounts on hardware wallets. All of that in the Coin Bureau Deals page down below in the description. Now you go back to the video, I'm going back to chillaxing.
And this trend of gold buying is showing no signs of slowing. Goldman Sachs recently told investors that the rotation into gold by central banks marks, quote, a structural shift in reserve management behavior, and added, quote, we do not expect a near-term reversal. But you don't have to take it from Wall Street, because central bankers are saying much the same thing. The World Gold Council has been polling a group of 69 central banks since 2021, asking how they expect global central bank gold reserves to change over the following year. This includes 45 central banks in emerging markets and 24 in developed markets. The proportion who say gold reserves are set to increase has grown every year since 2021, when it was 52%, right through 2024, when it was 81%. As of last year, there were 0 respondents who said they expect gold reserves to decrease or answered don't know. But there's an element of mystery about this accumulation too. As sovereign entities' share of global gold demand has increased, the market has become more opaque. Central banks disclose their purchases to the IMF, but often with a lag. Meanwhile, other official institutions, such as sovereign wealth funds, tend not to publish their holdings at all. As such, the reported figures we're working with don't paint a full picture, and that could explain why gold continues surprising to the upside. The World Gold Council has noted a very large and growing disparity between its own official sector demand estimates and the data published by the IMF. According to the World Gold Council, the proportion of its demand estimate that was reflected in IMF data fell from 47% in 2023 to 34% in 2024. And in Q1 of this year, the World Gold Council says that it's down to just 22%. Mind you, this is only data from one quarter, but it appears as though a large majority of gold being snapped up by central banks and other government institutions is not being reported publicly. There is anecdotal evidence to suggest that an increasing share of the global gold trade is going dark. Nikki Shields, head of metal strategy at the Swiss precious metals firm MKS Pump, observed that before the Russia-Ukraine war, futures positioning and ETF flows explained some 86% of the price action of gold. She says this figure has since dwindled to 13% year to date. According to Shields, the remainder was a combination of central bank, physical, and OTC gold flows, which together made the market much more opaque since 2022. It's likely no coincidence that sovereign gold buying is going increasingly underground amid a global ditching of US dollar assets and the election of a US president who has publicly threatened to punish countries entertaining the idea of de-dollarisation. Now, central bank buying isn't the only thing sustaining the gold rally. One of the more recent phenomena driving up the price of gold is an explosion in investment demand among retail investors. And this sector of demand includes gold ETFs, bars, and coins, and has grown rapidly over the last year, even as overall gold demand stayed relatively flat. In the first quarter of 2025, total global gold demand was up just 1% year on year, but in the same period, global investment demand for gold was up 170%, reaching 552 tons. And this is more than double the amount of gold bought by central banks in Q1 and includes 315 tons of gold bars and coins. Leading the retail frenzy is East Asia, where investors are certainly feeling the FOMO. As such, many of them seem to be buying in because rather than despite the fact that the price of gold has reached dizzying heights already. Last month, crowds of hundreds of people in Hanoi were seen lining up for hours just outside a jewelry store to get their hands on some precious gold. Supply constraints have forced stores to limit purchases to 37.5 grams per person per day, and they're still unable to meet this demand. Meanwhile, South Korea experienced its own gold boom in Q1, complete with a golden kimchi premium. Surging demand collided with local shortages to push the local price of gold up to 24% above the international spot price in February. And in April, Korean exchange data showed that average daily trading volume in the local market was up 342% year on year. But most significant for the global gold market is, of course, China, which is generally the world's top consumer of gold. This year, local retail investors have been on a buying rampage that saw China's share of global gold ETF holdings double, from 3% in January to 6% in April. In Q1, gold ETF inflows reached 70 tons, or about $7.4 billion, more than double China's previous quarterly record inflows. By the end of April, China accounted for more than half of global gold ETF inflows. Demand has been so strong in China that at one point last month, gold was trading at over $100 above the global spot price, prompting the Shanghai Gold Exchange to warn investors to, quote, manage risk and make rational investment decisions in light of recent gold price fluctuations. Last year, Beijing introduced import quotas to satisfy rising domestic demand for gold, and it has recently had to increase them to keep up with the appetite from retail investors. And this strategy is notable because it seems to be about much more than just gold. It's also advancing Beijing's foreign exchange rate goals. As you may have heard, Asian currencies have been rallying against the dollar recently amid a global de-risking from US assets amid Trump's chaotic trade war. And the Chinese yuan is no exception, and this is more bad news for Chinese exporters for whom tariffs are already a pain in the neck. After all, a stronger currency means less competitive exports. Beijing isn't taking this sitting down though, and it appears to have spotted an opportunity in the booming demand for gold in China. The government recently approved certain commercial banks to sell yuan for dollars and then use the dollars to buy gold to meet the newly raised import quotas. And this counteracts the upward pressure on the yuan and increases the demand for the US dollar, which has been tumbling recently. Aside from hitting two birds with one stone, this strategy suggests that China is not in any hurry to dethrone the US dollar, which is something to bear in mind when we talk about de-dollarisation. As usual, China is playing the long game here. Okay, so you get the picture. Central banks and retail investors are continuing to scoop up gold at a record pace. Gold has decoupled from just about every other asset on its current moon mission and doesn't seem to be running out of fuel anytime soon from a fundamental perspective. And that's not really great news though, because chaos and uncertainty are gold's favorite fuel. The optimistic take here, though, is that at some point, one of these central banks or cohorts of FOMO-stricken retail investors will realize that there is a much better alternative that you don't need to dig out of the ground only to put back into a subterranean vault at a great cost. And if you happen to be watching this video from a central bank and want to learn why Bitcoin is a better investment than gold, you can check out our latest video on that right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you very much for watching, and I'll see you guys again soon.